Happy Thursday, everybody, and welcome to session 3 of our new 8-part New to Investing webcast series. I'm Alex Coffey. I'm a senior trading and derivative strategist for Charles Schwab. I'm also the host of Next Gen Investing on the Schwab Network. For those unfamiliar with Schwab Network, it's produced by Charles Schwab's Media Productions. It is a separate but affiliated subsidiary of Charles Schwab. Now, before we get into the content for today, some general housekeeping things real quickly. All of our discussion today is for educational purposes only. Nothing discussed should be considered individualized investment advice. I will, at moments throughout today, be demoing a Schwab.com web platform experience. I'm going to be in a demo experience, so it's going to be paper money. There also might be some differences in how the functionality ultimately works in that demo experience versus the live account. Today's webcast, of course, is streaming here on YouTube. If you're in the YouTube chat, I got my good friend and colleague Ben Watson in there to answer any questions you may have throughout if you're catching this broadcast live. So make sure to say hi to Ben as well. Now, just a quick series overview. It is an 8-part series, as I mentioned. Today is session 3, and it's entitled Getting Started. Really, what I mean by getting started is we're going to focus on where and how investing actually begins to take place using Schwab.com as our potential launch point for that. So the first couple sessions, which we'll recap in a second, we're really focused on trying to introduce some of the topics and the concepts in investing as if this was a totally new just experience and embark on a new journey altogether from square one. So as you can see, 8-part series. We got the 8 parts up there from the beginning, very kind of theoretical, academic, conceptual, all the way through actually looking at how this stuff starts to work in practice. Then most importantly, we'll round out things trying to hope to show some of the common pitfalls that investors of all shapes and sizes, all levels of experience, battle on a day-to-day basis to try to make this as seamless of a journey for you as possible. But as we talk about throughout, investing is about assuming a little bit of risk or a lot of bit of risk or whatever level of risk you want for that potential for return. But what we're going to talk about today, again, it's about getting started on CharlesSchwab.com or Schwab.com, looking at where you kind of take some of these theories, some of these ideas, and you start to implement them in practice. And so we talked a little bit about what the series entails already, but let's recap sort of the general concepts of session 1 and session 2 as sort of a launch point for some of the things that we'll introduce today on the platform that kind of coincide with those learnings and those teachings. So session 1 was about the power of starting early. And throughout this, the key concept that we discussed is this idea of time and this idea of compounding. But before we really could do that, we had to really define the difference between saving and investing. And the easiest way to kind of quickly recap that is to think about saving in terms of storage and protection. So we're thinking about this in the context of money or in terms of capital. It would be the stuff that you're setting aside knowing it would be there. And for that, you're not really worried about return. Interest rates on a savings account may be relatively low, but what you're really most concerned about is the security that it will be there if you need it. And so that is sort of your emergency fund type of assets that, depending on who you ask and where you are in your life and what your responsibilities are, ranges from all sorts of sizes and could be measured in the amount of months. It could be whatever. And so that's going to be unique to the individual. On the other side, where really we focused and where that idea of compounding and time plays into things is this concept of investing, which is really what we're discussing throughout this 8-part series. And investing, to me, the best way to kind of think about this is, again, risk and reward being two sides of the same coin. In exchange for a little less security, a little bit less, or I guess a better way to say it would be accepting a little bit more risk, you're actually looking for that, that capital or that money that has been set aside for investing to potentially make more money. And the reason time is so important for that is, as a small amount of money or a large amount of money, whatever amount of money, makes some money, you now have that money, that new money that was made, also potentially working to make more. And so a visual concept that I think does a really good job of explaining this idea of compounding, which is just basically the concept that describes that wealth building over time, is envisioning a snowball, or the process of making one, and then rolling it down a snowy hill. And as you do that, it slowly but surely, it picks up a little bit more snow, and it becomes a very big ball of snow in a relative amount of time. And so as you roll that down, what maybe started as a fist of snow can turn into a much bigger mass of snow in time through that effort and through rolling it down the hill. And so that's a visual reference and kind of representation of what compounding is seeking to do. So over time, what was relatively small can sort of balloon in time if all goes according to plan. And so again, money makes money, which makes more money over time. That's the idea, and why time is so critical. In session 2, we talked about how the stock market works and really what it was. And to kind of go through that quickly, owning a share of stock represents ownership in a company. That company, if it's doing well, for whatever reason, the idea would be you buy a share of that stock, you are a small fractional owner of that company, its earnings or whatever it might be that excites investors increases the stock price over time, and that increase in stock price through appreciation is one way that you can make money. And then of course another would be dividend payments, which is essentially that company sharing some of those earnings that it brings in with its owners, the shareholders. And we talked a little bit about some of the risks, and we'll do that throughout our presentation in a bit. But company-specific risks, so that would be, a business has a disappointing quarter or a year. We use Nike for an example to discuss that. A company that was exposed to tariffs in its manufacturing, a company that's maybe had more competitors come into its space recently and just isn't making as much money as it used to. And as a result, its stock price has suffered. And there's also just broader market risk. I mean, if you were to look at the market performance today, it was generally weaker. And so even if a company doesn't have anything necessarily poorly going on today, if there's just a general negative tone in the marketplace, other stocks and companies can get caught up in that and see their stocks go down temporarily. And so those are, of course, risks that you assume as an investor on a day-to-day basis. Now with that, today is more about taking some of those concepts. I'm glad we had a chance to recap some of them so we can jump into our discussion and presentation and moving them into practice. But before you would ultimately make a decision to buy or sell a stock share, you may want to use some of the resources and tools available on the platform to do some research and do some homework on whether or not that would make sense in your investment plan. And so that's unique again to everyone, but we'll take a look at the platform here and give an idea of what you might expect. Maybe you've never seen investment platform before. And so I'll pull it up here. And so where we're at now is just Schwab.com. We're in the client experience. In this case, it's a demo account, as I mentioned. And we're on what for many is sort of the launch screen into their account. And so had you been on a different screen, how you find this is actually by going to accounts and clicking summary. And so you'll see that pull up here on our screen. Now what you'll notice first off is this demo account actually has no balance. And so What I've done is, to illustrate maybe what this would look like if you had a portfolio in this account. I took a screenshot and I have it here on our slide. So we'll click back to the slide deck here. And at the top of that screen, what you would see is based off the time frame. So in our screenshot here, it's a 3-month time frame. You see the total value of the account. You see how much it would be fluctuating maybe on that day. And then you see that selected time frame graphically represented, how it's fluctuated over time, because of course, as we've talked about, investments don't move in a straight line, they move around. And you see how that has performed over that selected time frame. So in this particular case, you can see the ups and downs, but in the end, over that 3-month time frame, up around 2%. And so as we pop back to our web experience here, the next screen that I'm going to illustrate here as we sort of show what this platform would look like is the position screen. So if we go into positions, what you would see here is the opportunity to kind of overlook your portfolio, not from the bird's eye view, but now we're actually down kind of in that nest and seeing what is comprised. And so if we take a look back at our slideshow here, we have a screenshot of kind of what this would look like if you had a few investments in a particular account. And so in this particular case, this particular demonstration screenshot, you can see carries shares in Walmart, RTX, Moderna, and Nebius, all different types of companies. And the reason a portfolio might be constructed that way is an idea and something that we'll discuss in a later topic, which is diversification. So as you see, those are all different companies. They all have different businesses. And the idea of diversification as a sort of a preview is that by spreading that risk among several different items or different investments, different stocks, different companies, is that they can perform, and that company-specific risks, so in this case, a Walmart disappointing, maybe didn't sell as many goods as investors were hoping, and seeing its stock price perform more disappointingly, you would be spread away from that company-specific risk by having some other shares in there as well. And so if we pull back up the platform here, what you'll see, and I think what's really important, is that although we can't see those specific investments, we can see how this can be customized. And so if we look at the screen here, this is the default columns that are on the screen. So some of these are quite important. How many shares you would have, how the performance of that particular stock or asset was doing that day, the value of it, the point in which you got involved with that particular stock, that would be your basis. And then, of course, whether you were up or down on that position, your gain or loss. What you can do, though, is you can actually go in here and change some of that to give different information. And one that I know is not a default column, but I think a very important one, is percent of account. And so we'll go ahead and we'll just illustrate what it would look like to add that. The reason I think that's an important column is we were just talking about diversification. We'll talk about that more in a couple sessions, but as you start building a portfolio and you're starting to think about what the risks may look like, a good benchmark for determining what your risk would be, well, how much of this account is assigned to that particular stock or that particular investment? And so that column will help do the math for you. Now, before you even get to the point where you have a position in the account and you're making the decision on whether or not you want to become a shareholder, many investors elect to do research or homework, or start to have that internal dialogue of, is this a stock that I want to buy? And one of the easiest ways to start with that, and this is something I believe Warren Buffett used to talk about, which was investing in things that you know, investing in products and companies that you're familiar with. And that's not a foolproof plan, but it can help you with the starting point. And so what we'll do today is we'll start with a company that we're familiar with, and I think most of us are familiar with, which is Apple. And so they make the iPhone and AirPods and iPads and MacBooks. And so you could simply type in Apple, as I have here, or you could key in the stock ticker, AAPL, and either way we'll click it. And so say we're like, hey, I think this is the right stock, but I'm not totally sure. It says technology hardware, it says storage, we see that there. If you go to the right side of our screen, you'll see something that says business summary. And so you can see even in just this sort of small one-sentence paragraph, they make smartphones, wearables, tablets. We might be on the right track, but say we want to do just a little bit more digging, you can click read more, and you start to see the company makes the iPhone, the Mac, iPad, AirPods. Now we have a pretty good idea we're in the right place. So you can read more, say if this was a company you weren't familiar with, you could get a lot of information as to what it does. But as you look around this screen, you'll see there's news, and this of course being a stock that, in a company that makes a fair amount of news, much of this is relatively timely. So most of these stories, all but one actually, have come out today, with one of them coming out last evening. You can see as well as you scroll down the share profile, so you can get an idea how big the company is in terms of value. We talked about dividends. You can see the particular dividend profile of a company in the case of Apple. We also have talked about earnings and the importance of that for stock price appreciation, and you can see that as well. So these would be things that would fall into fundamental analysis and the discussions around the holding being something that makes sense, from a financial standpoint. There's also another type of analysis called technical analysis, which takes a look more at the chart. And so as we scrolled up, you'll see that the chart was on the screen. If you click show more, as I have, it pops the chart into a little bit bigger full screen format. And one of the things we talked about last week was the idea of how over time, if you find a successful business, as Apple has been, although it has gone up and down, time had really provided that opportunity for this to compound for investors. And you can see that, right? 10 years ago, this stock on a split adjusted basis was, quite a bit lower than where it is now. And so, in the, double digits, the low double digits, 20, 25 bucks, all the way up to, over 300 now. But a technical analyst or technical analysis would suggest looking at this visual representation and looking for patterns within the performance on the chart is sort of a visual representation of that market's psychology. And you can see how it has performed over time, perhaps recognize some of those patterns, and perhaps use that as an idea for something that could, not always, give you an idea of how it may perform into the future. We talked a little bit about Nike last time, but what I wanted to do before we go is talk about building a watch list. So we have our two names that we talked about, Apple and Nike, from last time and into today. If you go underneath research and then you click watch list, it'll populate the screen that allows us to actually click and create what you could almost kind of think about as a shopping list. Of course, you're not forced to buy any of these things or sell any of these things or do anything with them. But much like when you're going to go to the store, you get your grocery list out just so you don't forget, and you have your ideas. You don't always end up buying what's on the list. You look and you see if you want to after the fact. But we'll call this the new to investing watch list. We'll go ahead and hit save. And we talked about Apple already, and so we'll key in AAPL and we'll click it. You can see it's populated now on our screen. NKE, if we remember from last time, is Nike. We'll pop that onto the screen. And now, if we wanted to step away and come back to this, however long into the future, this would be saved on our platform and give us a chance to set it to the side, get back to what we were doing, and come back at a later date and still see that on there. It also gives us a chance to monitor those names, and say we were waiting for something particular to happen before we were interested in actually buying it. We could monitor them now on this screen. If that were to happen, we could then go in, and what we'll discuss next time around is actually going in and maybe making that first decision, that first purchase. So That's going to do it for today's session. I hope everybody has a wonderful extended holiday weekend. We'll be back next Thursday with part 4, and that's entitled Your First Investment, From Idea to Action, and we'll take it from here and we'll move into potentially where that first trade could happen. So thanks everybody for joining, and have a great weekend.